Welcome to the final episode of our audit report playlist here at Let's Talk Audit and Assurance. So, previously, we were able to talk about the standard unmodified reports, including, of course, the unqualified opinion on the auditor as covered by PSA 700. Now, while we outlined the different sections of the standard unmodified report, we also paid a visit to PSA 701 when we talked about key audit matters. Subsequent to that, we talked about the additional explanatory paragraphs that do not actually have the power to modify the opinion. So these are paragraphs that will modify the report but will not modify the opinion. And we know this one to be our emphasis of matter paragraph and other matter paragraph. And then in the video immediately preceding this one, we visited PSA 705 when we talked about the modifications to the auditor's opinion, which would automatically result to a modification in the audit report as well. So here we are in the final run of our audit report playlist, and this is about other information, comparative information, audits of Group FS, and special purpose framework. So let's start by talking about other information. So can you imagine if the audited financial statements is included in other information, such as, for example, your client's annual report? What is the responsibility of the auditor with regards the other information? Now, remember that you have not audited the other information. What you have audited are the financial statements. But then the financial statements that you have audited are being reported together with the other information. Do we have a responsibility to the other information? The answer is yes, we do. And this responsibility is to read the other information. Now, why are we reading the other information when it is not part of the scope of our audit? Well, the auditor reads it in order to be alert to two things. Number one, the presence of material inconsistencies. This happens when items that are reported in the other information disagree with what is found in the audited financial statements. And secondly, you have to be alert for the possible presence of material misstatements of fact. Now, misstatements of fact would happen when matters not related to the financial statements are not correctly presented or disclosed. So you would get to see the difference between the two. Material inconsistencies has something to do with the FS because the inconsistencies happen between the other information and the FS. But when we talk about material misstatement of fact, this is an inconsistency that is not related to the items reported in the FS. Okay, so with that, like what we have said, it is the auditor's responsibility to read. Yes. Now, what will happen if the auditor found a material inconsistency? So, when the auditor has determined that a material inconsistency is in place or has happened, the auditor will first have to investigate to know which of the two sets of information, is it the FS or is it the other information, that contains the misstatement. Okay, so if you can imagine, you have audited the FS, you have not audited the other information, but you have read it. You first have to determine which of these two is telling the truth. So, in instances whereby the auditor has determined that amendment is necessary on the audited FS, meaning to say the fault is in the FS. The FS contains the misstatement, the other information is correct. The auditor must then approach management and request management to amend the financial statements. If management amends the financial statements, then there will be no problem. However, if management refuses to amend, the auditor must modify his opinion by expressing either a qualified or an adverse opinion. Now, you might ask, Miss, why only qualified or adverse? Why not disclaimer? Remember, you were already able to do the audit. You were able to perform the audit. You were able to see that there is a misstatement. So, therefore, we cannot give a no comment, right? So, we can give either qualified or adverse opinion, assuming that management refuses to amend the financial statements and it is in the financial statements that the misstatements lie. All right. Now, if amendment is necessary in the other information, so if the amendment is necessary in the other information which we did not audit, we again approach management and we request management to correct, okay, the inconsistency. Now, if management refuses to correct the other information, The auditor will then consider adding an other matter paragraph to the report. Remember, other matters? They're intended to highlight something that is not found in the financial statements. So we want to highlight the fact that there is a material inconsistency, but that the inconsistency happens in the other information and the FS is just correct. Or the auditor may consider withholding the auditor's report until and unless management revises the other information. And the third option is the auditor may choose to withdraw from the engagement. So we have to take note that these are options. Okay, the auditor will not have to do all of this. The auditor doesn't have to put another matter paragraph and withhold the report and withdraw. No, these are options. So it's an or. The auditor either adds an OM paragraph, withholds the report, or withdraws from the engagement. Okay, please take note that in this case, the auditor cannot modify their opinion, mainly because the financial statements are correct. The financial statements are okay. The misstatement or the inconsistency lies with the other information, which is not within the scope of our audit. Now, another inconsistency which you may find is a material misstatement of fact. So, as what we have mentioned, a material misstatement of fact occurs when other information not related to matters appearing in the FS is incorrectly stated or presented. So, what will happen when you uncover a material misstatement of fact? Again, you talk to management, discuss the matter with management, and because we have seen that there is a material misstatement of fact, we may request management to consult a qualified third party to resolve the matter. If management refuses to correct, well, at the very first instance, we always ask management to correct, right? If management cannot, they may seek a third party to help resolve the matter. However, if management simply refuses to correct, then notify the audit committee and, if necessary, obtain legal advice. Take note again that this is already beyond the scope of your audit, beyond the scope of the financial statements. And so, therefore, we have to tread lightly. Okay, that is why we will have to seek legal advice in cases where management refuses to correct. Now, we must remember in the case of other information, the auditor is not precluded from dating or issuing your report even if you have not obtained some or all of the other information. After all, again, it is not part of the jurisdiction or the scope of our audit. So we can still date our audit report even if we have not yet obtained some or all of the other information. Now, when the other information is obtained after the date of the report, you are not required to update your audit procedures. You're not required to update the procedures performed. Again, the only responsibility we really have is to read the other information. Another thing that we must remember is that the auditor's report shall include a separate section with a heading Other Information. So, in case whereby other information is present, or other information is included, or our report is included in other information and we have obtained it, so we need to include another section in the auditor's report with a label or a title or a heading other information. We do this one when at the date of the auditor's report, in the case of listed entities, you have either actually obtained or expect to obtain the other information. So take note of this one. If it's a listed entity, even when you are only expecting to obtain the other information, you already have to include the subsection or a separate section on other information with the heading other information for listed entity, even if you're only expecting to obtain this other information. However, for non-listed entities, you will only use this subheading and this section will only appear if you have already actually obtained some or all of the other information. Okay, so taking a look at how it will look like, how this section will look like, because we didn't actually discuss this one in the standard unmodified report, right? So let's present how it would look like. This would normally appear after the key audit matter. So notice we have a subheading or a title that says other information. Or if you may, for example, use other appropriate titles like information other than the financial statements and the reports thereon, okay, and the auditor's report thereon. Something similar to that. So how will it sound like? Management is responsible for the other information. The other information comprises, and then you name what is the other information. Okay. Our opinion on the financial statements do not cover the other information, and we do not express any form of assurance conclusion thereon. Remembering again that we only read the other information. We didn't examine it. In connection with our audit of the financial statements, our responsibility is to read the other information and, in doing so, consider whether the other information is materially inconsistent with the financial statements on our knowledge or our knowledge obtained in the audit or otherwise appear to be materially misstated. If, based on the work we have performed, we concluded that there is a material misstatement of this other information, we are required to report that fact. We have nothing to report in this regard. So you will see this particular section of the audit report where we will include the heading and where we will state that it is actually management that is responsible for the other information. We have only read it, and in cases whereby we have noticed an inconsistency, we are required to report it. Okay, so this is the content of the other information section. Okay, so let's take a look at what this definition is. It is called a document, or it's a document or a combination of documents prepared typically on an annual basis by management or those charged with governance in accordance with law, regulation, or custom, the purpose of which is to provide owners or similar stakeholders with information on the entity's operations and the entity's financial results and financial position as set out in the financial statements. This is what we call the annual report. How about this one? What do we call financial or non-financial information other than the FS and the auditor's report thereon included in an entity's annual report? That is our other information. Okay, so just remember, if it's other information, determine if there are material inconsistencies or material misstatements of fact, and then decide moving forward what to do with it based on our discussion. All right, so we're done with other information. Let's now talk about reporting on comparative information. So, actually, comparative information is referred to as the amounts and disclosures included in the FS in respect of one or more prior periods in accordance with the applicable financial reporting framework. And I'm pretty sure if you have ever seen a financial statement, that financial statement is presented in the comparative, where there is more than 1 year that is presented in that financial statement. That is actually what is filed with the Securities and Exchange Commission. So let's take a look at the two financial frameworks for comparatives. There is what we call corresponding figures, and then there is what we call comparative financial statements. I would like to refer to the corresponding figures as the clingy figures. They will only make sense if read together with the current period. These are the types of comparatives who would tell the current period that my life will not make sense without you. They need to be read together with the current period. They are considered to be an integral part of the current period. And because they are an integral part to the current period FS, the level of detail that will be presented will depend on the needs of the current period. As such, it would be like it, yeah, you can maybe liken it to like saying the corresponding figures and the current period FS are one. No, when two have become one. So this is their version of that. And because they are viewed simply as one, because the corresponding cannot make sense without the current, then the auditor will not make a specific reference to the corresponding figure. In fact, when the auditor gives an opinion, the auditor gives an opinion only on the current year FS. It's not There is no separate opinion for the corresponding figures. As compared with comparative financial statements, I would like to call the comparative financial statements as strong, independent financial statements. These are complete sets of financial statements that are presented for the sole purpose of being able to compare it with the current period. They can stand alone. They do not form part of the current period FS. It's just kind of like they're paying the current period FS a visit just to provide more context. No, but they do not form part of the current period FS. They are strong, independent financial statements. Now, in terms of the reporting, as what we have mentioned, if it's a corresponding figure, because they are an integral part of the current period FS, the auditor reports only on the current period. The corresponding figures are not specifically identified. However, when you talk about reporting for comparatives, then in the case of reporting for comparative financial statements, then in the case of comparative financial statements, then the auditor will have to give an opinion for each period that is presented. Okay, now going back to corresponding figures, because we are saying that the corresponding figures are an integral part of the current period, whatever is the status of the corresponding figure also affects the status of the current period. What do we mean by this? If, for example, the opinion on the prior period, which is the corresponding figures, if the opinion on the corresponding figures is modified and it has not been resolved, even the current year opinion will also be modified. If the opinion on the prior period of the corresponding figure is unmodified and evidence suggests that a material misstatement exists in the prior period and there is no proper restatement or correction, then even the current period will receive a modified opinion. So you get to see with corresponding figures, because they are an integral part of the current year, whatever happens to the corresponding figures will also have the same impact as in the current period. Whatever is the status of the corresponding figures, for as long as they are not revised, they have not been restated, they have not been corrected, then such will also become the status of the current period. Okay, so that is for corresponding figures. In the case of comparative financial statements, as what we have mentioned, the auditor will issue or will give an opinion separately on each period. The auditor will make a reference to each period. And I think you have seen this one in most audit reports when the auditor, for example, says, we have audited the financial statements of, for example, XYZ company as of and for the years ended 2022 and 2023. So there is a specific reference to each period because the opinion is expressed individually on each period that the financial statement or each period that is presented. Okay, now this can either be, or you may be able to encounter the following circumstances. For example, it's possible that the prior period FS was audited by a continuing auditor, meaning to say last year you were the auditor, this year you're still the auditor. Or it's possible that the prior period FS was audited by another one. And this prior period, which was audited by another auditor, is now currently being presented side by side with the year that you have audited. So if you take a look at the two-period financial statement, then it would seem like prior period is audited by somebody else, current period is audited by you. And the third possibility is the prior period may not be audited at all. So let's take a look at the implications of this to our audit report. So if the prior period was audited by you, you are the continuing auditor, then you should cover the current year FS as well as those of the prior periods that you audited. Please remember that you are not simply going to reissue your opinion on the prior period, but you should update your report. You should update your report on the prior period. How do you do that? Either you re-express the opinion originally issued, say for example, unmodified the first time you audited it, now presented as a comparative, it's still unmodified. Or it is possible that you express an opinion different from the one originally issued, such as, for example, there was a qualification of the opinion last year by virtue of foreign exchange transactions, but in this year, when it was presented in comparative form, there was a proper restatement. Okay, so management has revised and restated the financial statements of the prior period when presented together with the current period. So in that case, you may express an opinion different from the one originally issued. Okay. Now, in cases whereby the auditor has changed his opinion from the one originally issued, qualified originally qualified, but then the client has already corrected, and when presented with a comparative this year, it has already been cured. Okay, the qualification has already been cured. Then the auditor's report should include an other matter paragraph. This other matter paragraph will highlight the fact that you have changed your opinion. That's why we are using other matter paragraph, because what we are highlighting is the change in our opinion. So the other matter paragraph will state the fact that the updated report is different from the previous opinion. It will state the date of the prior year's report. It will state the type of opinion previously issued and the reasons for changing the auditor's opinion. So we have to highlight that one in an other matter paragraph. Now, what if the prior period FS was audited by another auditor? So there was a predecessor auditor. What will be the implication on this of this on our report? So there are two reporting options. Number one, if the predecessor auditor agrees to reissue the audit report on the prior period FS. So if the predecessor auditor is, still willing to reissue the audit report, then the predecessor auditor will compare the current period FS with the FS that was audited, discuss with the successor auditor any circumstances or events that may affect the prior FS, and obtain a letter of representation. So, in other words, when the predecessor auditor willingly reissues the audit report on the prior period, the predecessor auditor has to take steps to ensure that the opinion is still valid. Okay. However, the more common scenario is that the predecessor auditor generally no longer wants to reissue the report on the prior period FS. And if this happens, we cannot force the predecessor auditor. After all, there is no more engagement. So the successor auditor or the current auditor may include an other matter paragraph. And the other matter paragraph is intended to highlight the fact that there was somebody else that came before you. And the other matter paragraph will state, firstly, the fact that the prior year FS was audited by another auditor. You don't need to drop names. You don't need to name the other auditor. You just have to state that it was audited by another auditor. Then you will state as well in the same other matter paragraph the date of the predecessor auditor's report and then the type of report issued by the predecessor auditor. Now, if the predecessor issued a modified opinion, then your other matter paragraph should also state what was the reason for the modification of the opinion of the predecessor auditor. Okay, so this is what happens if the prior period FS is audited by somebody else. Now, what if the prior period FS is not audited at all? Okay, and it is presented together with the current period which you are auditing or which you have audited. Then the incoming auditor should again use an other matter paragraph to state that the comparative financial statements is unaudited. Now, take note, even when we have highlighted the fact that the prior period is unaudited, this does not relieve us of our responsibility to perform an audit of beginning balances. Okay? So because of that, we need to perform appropriate procedures to enable us to get sufficient and appropriate evidence to provide a reasonable assurance that the beginning balances of the current period that we are auditing, which is the ending balance of the prior period, which, if you would remember, is not audited, do not contain material misstatements. Okay? By the way, before we go to that slide, we also get to appreciate the fact that the beginning balance affects the ending balance, right? So if there are misstatements to the beginning balance and these misstatements have not been corrected or have not been revised, then the ending balance will also get a modified opinion. So similar to the corresponding figures, the beginning balance will affect the ending balance. So whatever misstatements found in the beginning balance will most definitely affect your opinion on the ending balance of the current period. Now, we have been talking about corresponding figures and comparative financial statements. So, what is this? So, we see here a complete set of financial statements where there are two periods presented. This is, of course, an example of a comparative financial statement. Okay, so let's try to apply some of these concepts by evaluating if these statements are true or false. Let's start with statement number one. The auditor's opinion should refer to the corresponding figures because the auditor's opinion is on the current period FS as a whole. We recall corresponding figures are an integral part of the current period. They are the clingy type of comparative information, and because of that, they will be seen as one with the current period. There is no specific reference to the corresponding figure. Therefore, statement one is false. Statement 2. When the auditor's report on the prior period as previously issued included a modification of opinion which is already resolved in the current period, so the client has already corrected it, the auditor's opinion on the current period need not refer to the previous modification. And for this one, that is, of course, true. The client has already corrected it. Okay, the auditor only needs to highlight the fact that an opinion has, or that the auditor's opinion has been changed. Okay. Number three, or statement three, when the auditor's opinion on the prior period, as previously expressed, was modified, the unresolved matter that gave rise to the modification may not be relevant to the current period figures. Nonetheless, a modification may be required on the current period's financial statements because of the effects or the possible effects of the unresolved matter on the comparability of the current and corresponding figures. And as what we have mentioned, whatever is the status of the corresponding figure also affects the current period figures. So this is true. Another set of statements. Let's take a look at statement one. In the case of comparative financial statements, an auditor may express a qualified opinion or an adverse opinion, or disclaim an opinion, or include an EOM with respect to one or more periods while expressing a different auditor's opinion on the financial statements of the other period. And this is true because we know that comparative financial statements are strong independent financial statements, right? So you may express a different opinion on each period presented. Statement 2. The predecessor auditor may be unable or unwilling to reissue the auditor's report on the prior period financial statements, in which case an emphasis of matter paragraph may indicate that the predecessor auditor reported on the financial statements of the prior period before amendment. What you are trying to highlight is the fact that there is a predecessor auditor, and so therefore you should not use emphasis of matter paragraph. Rather, you should use an other matter paragraph. So statement 2 is false. So that's it about comparatives, no, and comparative financial statements and corresponding figures. Let us now move on to talk about audits of group financial statements, and this is covered by PSA 600. So if you can imagine, for example, affiliates or subsidiaries or branches, we call these as components. And if your client qualifies for consolidation, then the auditors, okay, the group auditor or the auditors must decide who amongst them will serve as the group auditor. So the other auditors will now be called component auditors. So there will be a group auditor who will be the one to sign the audit report for the consolidated financial statements. So the very first step is to determine who will be the group auditor. Now, a very important reminder, in the Philippines, the group auditor is not allowed to divide responsibility on the audit. And so therefore, the auditor's report on the consolidated or group financial statements shall not refer to a component auditor unless required by law or regulation. So you have to be very careful about this one, because if you go to other jurisdictions like the United States, for example, they are allowed to divide the responsibility. If you see illustrative auditors report that would say auditors reports that would say, in our opinion, we have audited the financial statements of XYZ company except subsidiary A, which is audited by another auditor, then that may be allowed in the United States, but that is not allowed in the Philippines. We are not allowed to divide the responsibility. And so therefore, the group auditor does not mention the component auditor. Okay? So, a component identified by the group engagement team that is of individual financial significance to the group, or that due to its specific nature or circumstances is likely to include significant risks of material misstatement. What do we call this component? We call this one as a significant component. So, speaking of components, okay. Now, let's evaluate the following statements. Statement 1, the group engagement partner is required to be satisfied that those performing the group audit engagement, including component auditors, collectively have the appropriate capabilities and competence. And statement 1 is true. Remember that you are not allowed to divide the responsibility. Therefore, when you sign the auditor's report on the group FS, you must have already been satisfied with regards to the capability and the competence of the component auditors. Statement 2. The group engagement partner is also responsible for the direction, supervision, and performance of the group audit engagement, and this is also true. Being the group engagement partner or the group auditor, you are essentially taking on the responsibility for the entire audit. Okay, so you are responsible for the direction, supervision, and performance of the group audit engagement. Statement 3, the group engagement partner applies the requirements of PSA 220, that's on quality controls, regardless of whether the group engagement team or a component auditor performs the work on the financial information of a component, and this is also true. Again, for purposes of Group FS audits, it would seem like it's the group auditor that is the one who will take the overall responsibility for that. So at this point, you must be recognizing how important the role of the group auditor is, right? So you might also get to wonder, what if I am the group auditor and I am not satisfied as to the audit of a component? What should I do? So if you're a group auditor and you're not satisfied as to the work of the component auditor, you have the option of either number one, performing the audit yourself on that component. So since you're not satisfied, then you do the audit yourself on that particular component. Or you may decide, you may evaluate the impact of that component on the group FS, and if needed, you may decide to modify your opinion based on that component of the group FS. Again, you take the ultimate responsibility for the entire group. So if you're not satisfied with the audit of one component, you either do it yourself or you consider the impact of this as if it was not audited at all. Will it have an impact on your opinion on the group FS? Okay, so that's for group financial statements. Now, a while back, we made mention that it is possible that the prior period was not audited at all. So let's now take a look at beginning balances or opening balances rather. Most particularly important for auditors who are auditing a company for the first time and the beginning balance may not yet be audited. So what is the responsibility of the auditor? To obtain sufficient and appropriate evidence with regards to the opening balances, because the opening balances will affect the ending balances. So like what we mentioned a while back, whatever is the status of the opening balance eventually affects the current period. So therefore, if the auditor was not able to obtain sufficient appropriate audit evidence on the opening balance, then the current period will include or will have either a qualified or disclaimer of opinion. Because remember, this is a scope limitation. And a scope limitation, you could give either qualified or disclaimer depending on the pervasiveness, right? So in this case, if you were not able to test, if you were not able to audit the beginning balance, then the ending balance will also be affected. The audit opinion will either be qualified or disclaimer. If the opening balances contain misstatements and these have not been corrected, then the ending balance of the current period, which will be covered by your audit opinion, will contain either qualified or adverse opinion. If the current period's accounting policies are not consistent or have not been consistently applied in relation to the opening balance, there's a different set of accounting policies used in the opening balance and a different set used in the current period. And so, therefore, with that, the auditor will have to modify their opinion. Okay. And finally, if the prior period auditor gave a modified report and the modification remains relevant and material to the current period, then the opinion on the current period will also be modified as appropriate. So you get to see whatever happens to the beginning balance also affects the ending balance. So even if the beginning balance is unaudited, we still have to perform audit procedures to ascertain if they do not contain material misstatements, or even if the beginning balance has been audited by another auditor and the other auditor gave a modified opinion, we also have to check if the modification has already been corrected. Otherwise, this will all result to a modification in the current period opinion as well. All right. Then let's talk about other reports. So these other reports would cover, for example, reports on special purpose financial statements, those which are not prepared in accordance with PFRS, for example, audits of single financial statements or a specific element of a financial statement, or reporting on summary financial statements. So in cases of reports on special purpose FS, or these are those which use a special purpose framework. So we do remember that when we talk about general purpose, so the idea is that it will be useful for a wide range of users. For a specific purpose, then we use a special purpose framework. Examples of these frameworks will be the tax basis of accounting, the use of the cash basis of accounting, or the financial reporting provisions established by a regulator, or even the provisions of a contract. So notice that instead of using PFRS, the client uses these frameworks. Okay, So when the client uses these particular frameworks, the client will have to disclose this in the notes to financial statements because you are required, or the client is required, to disclose the framework being used. So in the case of special purpose frameworks, the PSAs that are observed in the audit of general purpose frameworks are the same. Okay, so thankfully it's the same. The process is the same, the rules are the same. So the procedures also that are under your arsenal are the same. So PSAs observed are the same. The auditor's report on the special purpose FS should then include an emphasis of matter paragraph. We are going to refer to the note in the financial statements that indicates the type of framework being used. And to do that, we will utilize or use the emphasis of matter paragraph in order to alert our readers. Now, the auditor may also consider it appropriate to indicate that the auditor's report is intended solely for distribution to specific users. As what we have mentioned in the case of special purpose frameworks, then it's for a specific need. And so therefore, the auditor may consider it appropriate to indicate that this is not suitable for all audiences, if you may, that it is suitable only for a specific set of users. So the auditor may then achieve this one by using, of course, our explanatory paragraphs. Okay. Now, what if you are being asked to audit only a single FS? Say, for example, the client will only want you to audit the income statement, or even a specific element of an FS, like the client will only want you to audit assets, or even specific accounts, like the client will only want you to audit cash. No, so will you be able, or are you allowed to accept such an engagement? The answer is yes, provided that the client understands that because the financial statements are interrelated, even when you are only auditing a particular FS or a single account or a single element, then you would still need to examine the other elements and the other transactions that would affect the element that you are auditing. So your opinion should be confined only to the specific account rather, or element that the of the FS, no? And when accepting this type of engagement, you need to examine other related accounts, and management must allow you to do so. Materiality should be decided based on the specific account and not on the entire FS. Okay, so because you're only auditing a specific account. And in order to avoid any misunderstanding as to the scope of your responsibility, then the report should not accompany the complete financial statements. Okay. Now, the auditor should express a separate opinion for each engagement. So, if you are, for example, the auditor of the complete set of FS, and you are also the auditor on, let's say, a single FS or a specific account, then express a separate opinion for each engagement. If the complete set of FS contains a modification, then determine if it is also necessary to modify the opinion on the single FS or in the single element. Imagine it this way. If the auditor gave an adverse opinion on the complete FS, di ba in the adverse opinion, we are saying the financial statements are not fairly presented. Therefore, that means the entirety of the FS is not fairly presented. So it will not be appropriate for you to report or to give an unqualified opinion on a single FS or on a component or on an element of the FS. So you cannot say that the entire FS is materially misstated, but then the cash account is okay. The cash account is fairly presented, right? So if it's adverse, then it's not appropriate for you to give an unmodified opinion on the components of that FS. But if it is qualified, since qualified, we're simply saying the financial statements are fairly presented except for. So if it's qualified, then it is possible that the single item or account that you have audited is not the cause of the exception, right? So for example, if the exception is caused by foreign exchange transactions, and let's us just say the inventory is not affected by it. So therefore, you may have expressed a qualified on the complete set, but you may express unmodified on inventory. Okay, so you will consider what is the effect of the modified opinion on the single FS or on the specific element of the FS. Okay, now if the complete set of FS contains, this is what I have mentioned, if it contains an adverse opinion, It is not appropriate for you to express an unmodified opinion on a single FS because it contradicts the adverse opinion. Okay? You may do this only when you are not prohibited by law or regulation, the report on the specific element is not published together with the auditor's report, and the specific element does not constitute a major portion of the entity's complete set of financial statements. So, as a general rule, if you give an adverse opinion on the complete set, you cannot give an unmodified opinion on a single FS or an element of that single FS. All right. Now, I think, if I'm not mistaken, this might be the last item. Reporting on summary financial statements. Take note, it's not auditing the summary financial statements, but reporting on the summary financial statements. If you can imagine, for example, a more condensed version of the complete set of FS, like, for example, instead of seeing the line items, what you will be seeing will be the total amount for current assets, non-current assets, and then total assets, and then liabilities, equity, total liabilities, and equity. So there are no details. It's a more condensed form. Okay, it's an abridged form. So in that case, if you are asked to report on the summary FS, you can only accept that engagement if you were also the one who expressed an opinion on the complete set. And it makes sense, right? Because you cannot audit the summary FS. You can only report on it. You can report on whether it reflects what is in the complete set. So the only way for you to do that, the only way for you to accept this engagement is if you also audited the complete set of FS. Okay, so if the auditors report on the complete set of FS, on the unabridged or complete set of FS contains a qualified opinion, an EOM, or an other matter paragraph, but you are satisfied that the summary FS are consistent in all material respects with the complete set, then state it in your report. Okay, you still have to acknowledge the fact that you're simply reporting on whether the summary FS is consistent with the complete FS. So even if the complete FS contains a qualified opinion or a modified opinion, so you have to state it in your report. However, if the auditor's report on the audited complete FS contains an adverse opinion or a disclaimer of opinion, which is the extreme side of the modifications, then the auditor's report on the summary FS should also state this fact. And as a result, it is not appropriate for the auditor to then express any opinion on the summary FS because the complete FS from which it was sourced from contained the extreme modifications, adverse and disclaimer. So that's it. We have completed all of the necessary salient concepts for audit reports, including this last bit where we talk about other information and then comparatives, special purpose frameworks, summary FSs, and audits of single FS or elements of FS. So thank you so much for joining me in the audit report playlist. And I hope that you get to answer some multiple choice questions after this so that you can more or less apply the concepts that we have reviewed. So thank you, and I hope to see you in our next playlist.